To all of the loyal readers of All Aboard, I just wanted to say welcome back. I know that All Aboard has been gone throughout 2024, and I keep talking about how I'm going to bring All Aboard back. Well, we're finally here and we're back. And what I want to do is talk a little bit about the new format that All Aboard is going to have moving forward. So in 2023, when I started writing All Aboard, I had quite a bit more time on my hands. I was focused mainly on building Peachy Insurance. And so every 2 weeks, I would write a newsletter to the tune of 2 to 4,000 words, talking about what we're focused on, how we're building the agency, the successes we're having, and the failures that we're currently battling. In 2024, things got quite a bit busier. Not only were we building Peachy Insurance, we've hit 43 million, maybe even a little bit more. I'll have the exact numbers, in the newsletter itself. But we've also been building Next Call Club, helping agents all over the country grow using internet leads, outbound calls, and data analytics. And so I wanted to bring All Aboard back, and I've been thinking about the right way to do that all year long. But with all of the changes happening right now for so many agents all over the country, it doesn't matter if you're captive or independent, commission rates are changing, compensation plans are changing. There's TCPA changes coming in January, and it's going to affect the greater marketing environment. I felt like now was a good time to relaunch All Aboard in its new format. And so moving forward, All Aboard will be a combination of video and writing. And so instead of 2 to 4,000 words, it might be 700 to 1,000 words, including an 8 to 12 minute video where I go deep on one or two topics. So with that being said, I would like to formally relaunch All Aboard, and I will do so by sharing the 2025 strategic plan that we have for Peachy Insurance. It will talk about what we will be focused on and how we are dealing with the changes that have been implemented for the agency. So, with that being said, I will kick it over to the slide deck that I have prepared. I just wanted to say welcome back. Thank you for your patience. I hope that this strategic plan helps give you ideas on how to make your agency more efficient, better, bigger, or whatever goal that you have. As always, I'd love to hear from you. So at the end of the video or at the end of the newsletter, if you have questions, just shoot a reply to this email, and I'll be happy to talk through whatever questions you have. Thanks so much, and welcome back. Okay, so step one is going to always be defining the problem. And so the reason that we want to start with step one as defining the problem is because we cannot aim to fix something if we do not understand it. And if we don't understand what the root cause of the problem is or the goal that we have, all of the tactics that we are going to use to try to implement our strategy are going to just kind of fall short. And so the first step here is going to be defining the problem. And the defining the problem is really going to be talking about the effects of all the changes in compensation and commission rates going into 2025. And so let's talk through that a little bit. So for me, I'm going to move my face here. The total renewal impact of these commission changes, of these compensation changes, are going to be about $112,000. And so that's not monthly, that is for the entire year. Some of our commission rates are going up, like on bundled home insurance or other property, it's going up. But on auto insurance, largely it's coming down. Now, unfortunately for me, and it's not this way for everybody, but about 2/3 of the premium in my agency is under the auto insurance book. And so if 1/3 is home or property and 2/3 is auto, and auto's coming down and property's coming up, right, I'm going to have a net loss. And that is what we see here. So $112,000 is what we're losing on the renewal impacts. One of the things that we can think about is, okay, well, if we're going to lose this amount of money on renewals, well, that's okay. We can grow, we can get more premium, we can do these things. But the problem here is twofold. We are also going to be losing money on the new business side. So what we can see there is that we are losing anywhere from 5 to 8% on the new business side. And if I think about how much new business I'm writing this year, what I did was I took what am I trending to write this year, multiplied that by the change in commission rate. So, call it 7 or 8%. And then what I did was I saw that is the impact. So the total impact from the commission changes is going to be $341,000. So if I do in 2025 exactly what I did in 2024, the agency will make $341,000 less per year. And so Am I upset about that? I'm absolutely upset about that. Am I frustrated by that? I'm absolutely frustrated by that. But unless I'm going to take my ball and go home, I need to find a way to fix the problem. And so the problem here is that we need to recoup $28,500 per month to avoid laying people off or changing drastically how we operate the agency. And so I already know firsthand that I'm probably going to cut marketing spend. I already know that I'm probably going to work to get more efficient on the revenue side. I'm going to work to get more efficient on the cost side. And what I mean by that is I don't want to lay people off, because at the end of the day, when we're going to cut costs, the most important thing that you remember is that you never want to cut costs that lead to revenue unless there is nothing left to cut. Because if you cut costs that lead to revenue, not only are your costs going down, but your revenue is going to go down as well. And yes, you might pick up some profit, but you're not going to have the revenue or profit impact that you think you are going to have. And this can lead to a slowdown in new business and put yourself in what's called death spiral. A death spiral means that revenue is dropping, costs are going up, and you lead to insolvency. So my goal will be to recoup $28,500 per month. So let's think about this a little bit. And before we get into how we actually solve the problem, I do think it's important to just think about, well, how does this compensation plan compare to the old compensation plans that we have? And so something that I like to do is like to look at three different metrics. One is going to be LTV, which is lifetime value. That is how much revenue that we get from a customer, a household, a policy, an item, whichever way that we want to calculate this, over the entire life, right? So new business commission plus all the renewals over time is the lifetime value. Then we look at NPV, which stands for net present value. And what net present value does is it says, if it's going to take me 10 years to get all those cash flows, what are all of those cash flows worth in today's dollars, right? So what we're really measuring here is what is our opportunity cost. So maybe you're going to get $10,000 over 10 years. Well, with interest rates being the way they are, you could have invested that money. Maybe that's only worth $6,000 in today's dollars, okay? So net present value is the second number. And then the third one I wanted to look at is what is year one cash flow? And so I took a look at all these compensation plans and I said, okay, well, we had pre-2020, which was 10 on new, 10 on renewal. Then 21 to 22 was the first iteration of variable compensation. 23 to 24 is the second iteration of variable comp. And now 25 is now the third iteration of variable comp. And so I ran all the numbers and I said, well, what happens to lifetime value, net present value in year one cash flow? And in all of the scenarios, the numbers went up. And then I had people say to me, well, you know what? You've got to include inflation, right? Because inflation is here. Rates go up, but so did inflation. So I adjusted for inflation. And so again, I'm not defending anything. I'm not advocating for anything. I just wanted to purely look and say, what are the numbers? Okay. Of course, this is only looking at the revenue side. I'm not looking at what your costs are, what my costs are, or anything else that's changed over time. But what we can see is that lifetime value, net present value in year one cash flow has increased consistently over the iterations of the comp plans. And the reason for that is because premiums are so much higher than they were before. In my agency alone in Georgia, home premium is up 30% compared to what it was at the beginning of 2024. Auto premium is up about 16%. And so we can see the total change to the right. On the home side, it's 64% on LTV. That's incredible, right? We haven't had 64% of inflation since 2020. It's something like 20 or 23% in the last 4 years. So we are ahead. Of course, we have to look individually in our agencies at what our costs are and what our costs are doing. The challenge here is that we have a cash flow bridge that we have to bridge. You'll see in 23 and 24 that the average cash flow is 560 to 580. Right? But we're looking at a 2-year time frame here. We're not looking at the last 2 or 3 months. So the cash flow that we're getting right now will drop into next year because we're looking at a much more compressed timeline. So to put this in terms, I think that we can all hear is that, we are actually better off than we were 4 years ago from a larger perspective, right? The values of our books, in my opinion, should be going up because the lifetime value of those books are going up. Of course, that is a compounded challenge because there's uncertainty, there's volatility, right? Whenever these things happen, a bunch of people go to sell their agencies, which creates increased supply, which brings the price down. However, if we're looking at fundamentals of agencies, right? When we value agencies, we're looking at cash flows. We're looking at like what are the actual values of these cash flows worth to us. Values are going up from a pure math and fundamental standpoint. Of course, at the end of the day, the fundamentals don't really matter to some people, right? Something is worth what somebody is willing to pay for it. And if there's uncertainty in the future, that might compress the value of books. But I'm here to tell you that the lifetime values are going up, and that is a good thing for long-term book value, okay? Now, with all that being said, we are going to be worse off than we were in Q3 and Q4. Q3 and Q4 of 2025, we are now getting higher premiums than what we're used to in the last 2 years because of all the rate increases, and we're still on the existing comp plan. So when this changes, that cash flow is going to drop, and we are going to have to bridge that gap, which I will talk about next. So that leads me to step number 2. We have defined the problem. Okay. We see this is where we were. This is where we are now. I'm losing $28,000 in revenue. So, how do we actually use step 2 to find the solutions to recoup this cash flow, ideally in a more profitable and efficient way so we can grow profitably and continue to thrive in the new environment? So, let's go ahead and walk through it together. And let's talk about it in the sense that what we want here is renewal replacement. So, the first step is we got to find out how much money we're losing. We've done that. We know part of it's from renewals. We know part of it's from new business. So step 2 in finding the solution, let's think about renewal replacement. When this was announced, it was the end of October, or maybe it was like the first day of November, something like that. And at the time, I didn't even have October's growth numbers out. And so when they first announced the changes, obviously I was a little bit shocked and a little bit frustrated. And I took a step back and I said, okay, well, if I'm going to lose $110,000 or $120,000 of revenue, I've got to get that back. When it comes to renewals, the way we get that money back is by growing. And so I had to think about, I said, how much are we growing every single month? And so I figured that number out. That number was about $500,000 in premium. And so what I did was I look at it every single month, and I know we're growing anywhere from 450 to 700,000. But just to be safe, we say 500,000 per month. If you want to figure this number out for yourself, just pull your the last metrics report for your agency of 2023. Look at your most recent, divide by the number of months, and that's how much you're growing per month. So I'm growing 500,000 per month. And so if I thought about it and I said, all right, well, we've got November, December, January, and February, because these effects go into place on March 1st. Well, we're going to grow about $2 million. And if I count October, because I didn't even have October's metrics out there, we are going to have $2.5 million in growth by 3/1. So at a 7.5% renewal rate, which I think is conservative, that recoups $187,000. Now, should I have $187,000 more dollars for the agency to invest in people, staff, bonuses, commissions, marketing, et cetera, et cetera? Absolutely, we should have that, but we don't have that. And so that's the reality. And so I'm more focused on how do we actually get that money back. And I feel confident that if we can just keep our pace of growth the same, we are going to recoup that money and mitigate that impact. Okay, so that is the good news there. The other thing that we'll be doing is we'll be attacking our monoline book, because our monolines, aka any customer who only has one line of business with us, will renew at a lower rate than that of somebody who has home and auto with us. So we will be working very hard in the back half of the year to go ahead and try and recoup some of that income by taking a monoline customer and bundling them up to become bundled. Okay, so then we need to think about, how do we get our new business revenue back? If renewal revenue is going to come back from growth and from attacking monolines, we have to get the new business revenue back as well. And so the way that we do that, right, is we can either write a ton more business, but it costs money to write business. We got to pay commissions, we got to spend money on leads or mail or live calls or whatever it is that we need to do, but we have to feed the machine. So I said, okay, let's get our baseline. For me, Q1 through Q3 home premium was around $1,700 in Georgia. At the end of September, or maybe it was beginning of September, we took a pretty substantial home rate increase of about 20%. And while this will hurt us on retention, it will hurt us on new business, we've seen challenges, we will recoup some premium. So I said, if we're at $1,750 average premium and we're getting paid 37% commission on that, that's about $647 of revenue. if I want to continue to get $647 of revenue, I need to do this math right here on the right side of the screen. I need to take that $647 and divide it by the 2025 commission rate to get my new 2025 target home premium. So I did that. The new one is 29%. We saw a 6%, 7% drop. Premium equivalent is going to be $22.30. So I've got to take our average premium from $17.50 to $22.30 to not miss a beat. Doesn't sound like the easiest thing in the world, but we're already moving closer to $2,000 premium at the end of this year due to the rate increase. Plus, we have a plan that I'll get into later in this video on how we actually recoup that premium. So the next thing that we need to do is we also need to think about what are the segments of customers that we have that we can focus on. And so what I did was I looked at all, 8, 9 segments here. And I said, okay, well, if we were at a multi-car renter, a single car mobile home, a single car homeowner, a multi-car homeowner, single car home plus an umbrella, multi-car home plus an umbrella, you get the idea, okay? We say, here's the year one cash that we get. And so for me, I've focused a ton on writing multi-car homeowners. And what we see here is that multi-car homeowners on average are worth about $1,200 in cash the first year. Do we write some single car homeowners? We absolutely do. Do we write some multi-car renters? Of course we do. But again, the thing that we focus on the most is a multi-car homeowner. But there's a lot of other segments out there. And so I started to look at, what if we added a flood? What would that do to cash flow? What if we added an umbrella? What would that do to cash flow? What if we, said, what is about a mobile home? What would that do? What I'm trying to do is think about what are all the chips that we have on the board and what makes sense. And so what I see here is that, a multi-car renter, has half the cash of a multi-car homeowner. That is not necessarily good or bad. It depends on how much it costs you to acquire and to service that customer. So with that being said, one of the things I want to point out is that there is value in all segment types here. That being said, if I'm getting a multi-car homeowner and it's giving me $1,200 in cash and a multi-car renter is giving me $677 in cash, I do not want to pay the same amount of money to acquire a multi-car renter that I do a multi-car homeowner. On the flip side, I should be willing to spend significantly more money to acquire a multi-car homeowner that has flood insurance as well. So the thing I want to point out here is understand what the year one cash you get is versus your cost per acquisition. There's this mindset that we can have is that, multi-car homeowners are the best and multi-car renters are the worst. There's pros and cons to both of them. Multi-car renters do not retain the same way that a multi-car homeowner does, but the premium on a multi-car renter is higher. So there's trade-offs here, okay? So price your segments the right way. So if you pay $500 per sale to acquire a multi-car homeowner, maybe if you're going to go after multi-car renter, you want that to be sub $250 because you're getting half the amount of cash. You don't want to spend the same amount of money to acquire them. So again, I can run this math for anybody out there if you want it. It is something I charge for. If I already work with you in a one-on-one consulting way, I can do this math for you as part of our program. If we don't work together and you want this math done, let me know. We can talk about what it would look like. So something to keep discussing here is that I am a lead heavy agent. Okay, I'm lead heavy. So I need to watch the TCPA changes that are coming because if volume drops and I'm too focused on multi-car homeowners, I'm going to either have to pay significantly more for those leads or go without those leads. So what I'm trying to do is think about, should I buy multi-car renter leads? Should I buy single car homeowner leads? And I think the answer for me is yes, I should, but I should not pay, $10 for a multi-car renter lead. Maybe I should pay $5 or $4.50. Whereas on a multi-car homeowner, maybe I should be paying anywhere from $7 to $10. I don't know. I'm thinking out loud. The prices on leads after the TCPA changes are going to be all over the place. It might be a couple months before we know where we land. So I want to encourage people to think about niches, right? What are you specialized at? What do you have that nobody else has as a carrier, as an agency? What can you focus on that other people aren't focusing on? There's riches in the niches. You don't have to be the best at everything. If you can be the best at one segment, there can be a lot of value there. So different segments have different average premiums and retention numbers. I touched on this a little bit earlier. A single car homeowner might have a higher premium, but might not retain as long. So we have to not only look at the year one cash, like we're seeing right here on this screen, but we also have to look at the lifetime value, which isn't necessarily hard to calculate, but it is a little bit tedious. The next thing that we want to do, right, is we want to use some analytics to make better decisions. This is something that we're going to be using a lot. We use analytics heavily at Peachy Insurance. And so what you can see on your screen is just what we call a product insights tab. And the metric that we want to focus on here is the expected annual premium per quote. That is an efficiency metric. And so what you can see all the way to the right is that a standard auto gives us the highest expected annual premium sold per quote, right? It makes sense. You can get 2, 3, 4 autos in one go. A lot of people tend to think that a homeowner's policy is the second most efficient. I used to think that until we actually did the math, and it turns out that a landlord policy is more efficient than a homeowner's policy. It doesn't mean that I want landlords instead of homes. I want landlords in addition to homes. So the way that we use these types of analytics, we say, okay, well, what's the efficiency rate here? If I had to ask for a third line of business, which one should I ask for? And so we use these insights to say, well, our service and sales team are going to ask, do you have any rental properties consistently over time? Towards the bottom, you can see that flood insurance is down there at 188. It's one of the most efficient things we can offer. Homeowners plus SPP, super valuable. So using analytics to make better decisions for your sales team, for your marketing, for your quoting will be huge. We offer a data analytics consulting service. I don't want to hammer that home too much, but we use dashboards and data all the time to make better decisions faster. Who should we train on what? Where are we succeeding? Where are we failing? Having data will help you make decisions faster, okay? So this is just the thing to remember. I just want to keep saying it. This is what we say to our agents. Monoline is death, bundling is life. Monoline is death, bundling is life. So agents will need to have a 3 or 4 line mentality to win moving forward. Everything is about getting more lines per household. It does not matter what carrier you represent or whether you're an independent. The more lines per household you have, the more valuable each household is going to be to you. The more premium you have in one household, the lower the cost to service that policy. Would you rather have $10,000 in premium on 10 households or $10,000 in premium on one household? Different answers, right? Some people might say, well, I don't want all my eggs in one basket. But now multiply it by 100. If you had 110,000 households or 1,000 premium households, I would take the bigger households all day long because, again, I don't have to pay as many people to service them as I would the big household. So step 3 is all about executing swiftly. So we've defined the problem. We've talked about some solutions. So we've said we need to recoup the premium. We're going to keep growing the same rate we are, and we're going to use analytics to make better decisions, okay? So I'm going to lay out how I used analytics to make these decisions. Step 3 is to execute swiftly. So let's talk about the tactics of what we actually want to roll out. So let's start with home premium. So we already talked about this idea. How do we get from $1,750 in home premium to $2,200? We are going to do that by looking at the optional coverages tabs on the home insurance policy. And the 4 that I've identified here is the first one, water backup coverage. Water backup is a small add-on that you can put on a home insurance policy. Granted, I know that every carrier will have different types of coverages, different states will have different coverages, different products will have different coverages. But again, I want you to think about the thought process rather than the exact solution here. Do you have extra coverages on any of your policies to get more and get more efficient? So for me, water backup is going to be one of those coverages. Another one is going to be mold coverage. I personally have had a water claim back in my Florida home. Mold was an extra like $20,000, and I'm very, very fortunate that I had mold coverage on that policy. It is not something that many home policies we see have. It's something that we are getting better at adding to policies, but we have a long way to go. It can be anywhere from $90 to $165. So if we're trying to find a couple $100 in premium, adding great coverages like mold coverage can be a huge boon or a benefit to try to get to that goal. Third, we're going to look at building codes. Building code coverage can be $75 to $150. I'm going through a claim right now. I had a tree fall and hit the deck on my house. the building codes are not up to date. And that coverage is saving my tail. It is giving me so much extra coverage that I would not have had otherwise that I've been coming out of pocket for. These are good coverages for clients that we can add on. Yes, it adds premium. Yes, higher premiums can make it harder to sell. However, we have really good products, really good coverages, and if we have the right reasons to help the customer make the decision to add these coverages, this gets significantly easier. So the last one is going to be extended jewelry coverage. In some cases, it makes more sense to schedule that on a jewelry policy or a rider, but not everybody has the appraisals, and so we can do extended coverage. These coverages together are good coverages that can add up to several hundred in premium, add a ton of value, not only accomplish our goal to get our premium up, but help the consumer as well. The next thing that we're going to do is we're going to focus on 2 extra lines. The first of that line is going to be flood insurance. I already laid out the segment above that the flood insurance segment had the highest year 1 cash. Well, here is the lifetime value calculation on a multi-car home with a flood versus a single car or a multi-car home without a flood, right? So you can see these here. Look at the lifetime value difference. When you add the flood insurance to the single car homeowner and the multi-car homeowner, you're adding, $2,000 to $3,000 of revenue over the lifetime of these customers. The net present value is higher, the year 1 cash is higher. And so for us, we will be spending a lot of time and effort training our team to talk about flood insurance. And the reality here is that flood insurance is both high premium and high retention. So sometimes, extra retention can drive the lifetime value. Again, that is the total amount of revenue you get from a customer. But in this case, it's both high premium and high retention. It's so important to talk about flood insurance because something like 35 to 40% of flood claims happen outside of flood zones. If you are in the Southeast and you were affected by any of the hurricanes this year, you know that a lot of places outside of flood zones had catastrophic flooding where people did not have flood insurance. And so that is what we are trying to avoid. There's a lot of flood zones in the state of Georgia, but there's a lot of flooding that happens outside of flood zones in the state of Georgia as well. A lot of people don't know this, but I think we get paid something like 17% commission on new business, and some carriers are going to be higher than that. This is just what I get paid. And last, flood insurance is the same price anywhere you go, assuming you're using a national flood insurance product. If you're doing a private flood or a flood that's included on a homeowner's policy, that might be a little bit different. But again, flood insurance is a huge opportunity for us in 2025 to recoup revenue, make more, and improve lifetime values. The next focus line that we're going to focus on is umbrellas, right? This is nothing new. This is not groundbreaking in any way. Everybody knows the value of umbrellas. But again, let's look at the lifetime value comparisons. So you can see that we get quite a bit of extra lifetime value, and a lot of this is being driven by the higher retention numbers. What we know is that autos with umbrellas retain about 2 to 4% higher than autos without umbrellas. Part of this, I believe, is because if you're moving the home and auto, but not the umbrella, right? Like all of these things, the more lines you have, the less competitive somebody will be undercutting your price. It's the same reason that sometimes you take a bunch of auto rates and somebody will change their auto, but not their home. They'll keep one line with you, but not the other. Well, because when you start bundling things together, a lot of times you end up very, very similar on price. So people will start to break things up to find savings and then kind of consolidate them back. Umbrellas require everything to be together. So umbrellas will be a huge, huge focus for us continuing into 2025. It should be a focus for both sales and service, right? There's no reason that both a salesperson and a service person cannot write an umbrella. It's quick, it's easy, stories sell. There's a lot of value and tons of claim stories that we can come up with to help drive that value. The next thing that we're going to do is we are going to focus on building out, continue building out our Advantage and NatGen focus for 2025. So this year, we took a gander at putting a person in a NatGen role on a revenue metric. And basically their goal was to write everything that the sales team wasn't going to write because it was ineligible with the mainline carrier. So this could have been NatGen Auto, this could have been log cabins, it would be classic cars, just kind of all of those extra little things that our main core sales team is not focused on. And so what you can see over here to the right is the lifetime value between a standard auto and a Nat Gen auto actually are very, very close. And the reason for this is because even though Nat Gen auto, we have a projected retention of 70%, which is only like a 3.3 year customer life, well, standard auto retention has dropped for me down into the high 70s, right? My overall retention's in the mid 80s, but my auto retention is like 79 and a half. And the reason for that is because we've just been taking rate after rate after rate after rate. Well, when you have a lower retention, your lifetime value comes down. And so with NatGen, the premium is so high that even with the low retention, you have a lifetime value number between these two products that are very, very similar. So with that being said, I don't want to focus on NatGen or non-standard auto. However, if we have a consumer who is getting a quote from us that does not qualify for standard auto, I would like to make sure that we take a shot at writing the non-standard auto. So we will continue to do that, right? Basically, the goal here is to not spend any marketing on this role. They just take the things from service and sales that get sent over. And this worked really, really well for us. It was ROI positive all throughout the year. We're looking to build on that and get even bigger. It is a way to add profitable revenue into your agency that maybe you are not considering right now. If you go through your expanded markets or any of your non-mainline carrier markets and look at what are the niches, you might find that there's some tremendous opportunity that you can capture without spending a single dollar on marketing, okay? The other thing to think about here is that, people would always ask me, they'd say, well, what does this person do when there's nothing to quote? I said, well, then they dial on the monolines, right? They'll dial on the current book of business. People who have one line and try to get that second line. So their whole goal is either write the things that nobody else wants but are still valuable from a revenue standpoint, or try to bundle up the rest of the household. So we've talked a little bit about the product lines we're going to be focusing on. We talked about how we're going to get premium coverage back. We've talked about how we're going to use our expanded markets. But now from a tactics perspective, one of the ways that we're going to drive more efficiency is by implementing quality assurance. This is not a groundbreaking process. Some agencies already have quality assurance where somebody is listening to a ton of calls to make sure they're hitting the checkpoints on every single call. And, I actually got this from one of my buddies named Justin Furman. He worked at the Allstate CCC for a number of years, and we were talking, and he said, when we were in the CCC, we would do training and this and that. And I asked him, I said, well, how many training calls do you do per month? And he said, we would do 2 training calls. And I said, there's no way that's enough. Like how are 2 training calls driving the results that you were trying to get? And what he said was, well, there was also a quality assurance team. And I said, tell me more. And when he started talking to me about the quality assurance team, basically what he said was that they would pull anywhere from like 10 to 20 calls randomly. And if they didn't have a high enough adherence score, it would affect their bonus. And so I started to think about that. And I said, how can I apply this in my own agency? And how can I do it in a way that doesn't feel like it's a hindrance to giving a great sales or service experience, but still gets us what we need? And so I am going to roll this out in 2025 for both sales and service. It's already rolled out in the agency for this year for customer service. But one of the main things that we're going to do is we're going to review every sales call and actually every service call for a referral ask. Referrals will be a huge part of our strategy going into next year. And what I want to do is I want to think about what are the 3 to 4, maybe I think I said 4 to 5 most important things that we can do on every single call. So for service, that might be one thing, and for sales, that might be something else. A couple things will be common across both departments, right? Referral ask will be super important on both every sale that's completed and every service interaction that we have. And the reason for that is that if somebody's buying from you, they're happy with you. And if they're happy with you, you'd think that they would be willing to refer you. And in a lot of cases, they are, but you need to ask. Same thing on the service side. If you're giving somebody an incredible amount of service and they're super happy with you, why not ask for a referral? If they're happy with you, usually people are willing to share that. So we will be looking for referrals all the time. I think on the service side, it might be something to do more with Google reviews, referrals, pointing out some really great things on their policy. On the sales side, did they mention if they were in a flood zone or not? Did they ask for a referral? And then of course all the standard things like, did you ask for the sale? And so again, what I don't want this to be is I don't want this to be a training scorecard, but I want this to be, hey, what are the few things that we need to do every single time to get more efficient to recoup or build revenue? Importantly, there will be a monetary impact for our team. It can be good or bad. It's the manager's choice. I'm more inclined to make it both stick and carrot. So if you don't do it, you have a punishment. But if you do it, you get a reward as well. So there will be no right or wrong decision there. I'm going to leave that to my department heads and the managers to make that decision. And they seem on board with it. So let's talk a little bit about referrals. I just talked about how referrals were going to be very, very important for us. And so here is the reason why. And so on your screen, you can see that I have the math broken out here. And number of sales is right here. So we make about 275 sales per month. You know, some months are higher than others, but 275 sales per month. And so what I'm thinking about is if we can get 33% of a referral rate of 33%, AKA we get one referral every time if we get one referral for every 3 sales we make, that's a 33% referral rate. So if we make 275 sales and get our referral 33% of the time, that's 91 referrals that we quote. Year to date, we are at 85% close rate on those referrals. And so that doesn't mean that we close 85% of the referrals that we get, but if we do 100 quotes on referrals, we're going to get 85 items. So for us, if I come over and move my head out of the way, you can see our average premium is around $950. That gets us 77 items per month and $18,000 of revenue. So if we can get a referral 1 out of 3 times, that replaces 65% of the lost income. And that's assuming that when we get a referral, we're only getting 1 referral. Sometimes people give us 3 referrals or 4 referrals or 5. So the idea here is that we're going to continue to give our sales team marketing. However, we are going to ask them to make sure they're asking for a referral every time, right? Hey, we gave you the lead. Now do your part and ask for the referral, and let's keep that chain going. The revenue impact is something that cannot be ignored, okay? We have to do it. And I think what I want to just point out here is the way that I did this math, right, is items sold divided by referrals quoted equals the close rate. And so I want to be very upfront with my math. Again, happy to do this math for anybody out there if you want it. This is pretty quick and easy. So the next one is flood. We talked about flood a little bit too. Flood is going to be important. We don't see as much of a revenue impact here, but if we sell about 100 homes per month, I think it's actually like the 130, 140 range. But if we can get a flood policy 20% of the time, you know, we're going to see another $3,000 of revenue. And that doesn't feel like a ton of money, but when we're thinking about $28,000, well, if we can get $3,000 over here and we can get $5,000 over here, and then we can cut marketing costs by $8,000 over here, you know, all of a sudden we start to recoup this money. And maybe some of these strategies can recoup all of it. But again, if we do a little bit over here, and a little bit over here, and a little bit over here, we can start to see a path forward. So 3K revenue monthly. Our average premium this year was $1,660. I did $850 for the illustration because I expect as we push more flood moving forward, we're going to write more flood that are not in flood zones, which are going to be lower flood insurance prices. Of course, we will have floods that are in flood zones too, which will pull those up. But again, I wanted to be a little bit conservative here. But the real win is the lifetime value add that we talked about before. So this one's I'm actually pretty excited about. It's something that I've ignored for a really long time. And so this is going to be nothing new to people who do a lot of referral partnerships. But I want to have a new role called head of partnerships. And their goal will be to build relationships that drive referrals. And so I wanted to ask these questions. I said, well, who fixes the most common claims? Because those people are going to have access to homeowners. And homeowners a lot of times shop after a poor claims experience. I also want to ask who has the type of customer that we want. And so maybe a car dealership isn't a great partner for you because maybe people don't have current insurance. But if they're a luxury car dealer, maybe they do have current insurance and maybe they are a really great customer fit for you. So ask yourself the question, who has the type of customers that we want? And then last is how can I use the home RMP to find partners? What is actually driving home rates? Is it the roof age? Is it type of home? Is it the build of the home, the year built of the home, right? Like how can I use those insights to find the types of people who can send me over referrals or maybe that I can help out as well? And so in this idea, right, I want to pay this person somewhere between $70,000 and $90,000 per year. It's a high wage. I'm not saying that everybody should pay $70,000 to $90,000 per year. I am inclined to pay a higher wage because I am in Metro Atlanta and I want a very smart, polished, and professional individual. And so I think that I'm going to have to be willing to pay a little bit more for that person. If you're not in a big city where wages aren't as high, you don't need to pay as much. Or if you have somebody who you think is willing to take a lower base with higher upside, that can work too. Again, I don't expect this role to be, crushing it overnight, but I think it will take time, which is why I want a polished, smart individual, which is why I'm willing to pay $70,000 to $90,000 per year. This role doesn't have to be out in the field all day. We live in 2024, we'll be in 2025. We live in a digital world where a lot of people can connect over Zoom, over phone calls. Yes, maybe you need to get out of the office sometimes, but not always. So this person will be able to build relationships to drive referrals. Their goal will be to minimize our marketing spend and add high retaining business that we don't have to pay a ton of money for outside of the wage. It pairs very well with our SEO strategy, which is search engine optimization, to try to get backlinks. So as we build partnerships, I will link to the partners page and they will link to our page. That makes us rank higher on Google. The more people can find us, the more people call us, fill out our lead forms, etc., etc., etc. This person will also be required to make content for social media, right? And so social media is one of the cheapest ways that you can start marketing. I've seen so many agents start to do this in the last year. Somebody I respect very highly, Nick Saka, has a mastermind out there called the Insurance Creators. It's a couple $100 a month, helps you get started in making content to drive referrals into your agency. Highly, highly, highly recommend checking that out, okay? So we're almost done here. A couple more strategies. One of the strategies that we're going to do here is that we are going to attack monoline. So first, I wanted to show you if we attacked our monoline homes, all right? So basically, we're calling people who only have a home insurance policy with us to write their auto insurance. In this case, I have 1,800 monoline homes. I'm going to call them and expect to basically quote 35% of them. And then of those 35%, we're going to close 20% of them. That'll give us 124 new auto policies, and that will turn into roughly $130,000 of revenue if we can pull this off, okay? This is just the monoline homes. Then if we cut over to the monoline auto households, we've done a pretty good job of attacking these this year with our NatGen person, our NatGen iVantage person. We don't have nearly as many of them, but what I want to go back to, and you see this year one cash flow, is $1,048. That was surprising to me because I said, well, I want to go after the monoline autos because that home pays 37%. Well, the thing I forgot is that sometimes these people are renters. So the actual amount of money that you get is more valuable on a monoline auto, a monoline home adding the auto than it is going after a monoline auto trying to add the home. But regardless, same numbers here, 35%. I said the close rate's a little bit higher because the property does close higher. We recoup 140,000. So together, we recoup a lot of money. This is going to improve retention, bring the renewal rates up. It's going to recover half of our lost cash flow. We have 2,700 total monolines, right? So there's a lot of room to run here. We have this new opportunity next year that anything that was bound by the service center, if we get an additional line, we unlock full comp. This is a low-cost, high-return option. It's something we've actually started already in November, which was a slow month. It's driving a lot of new business, okay? Okay, another strategy here. We will be using Next Call Club, which, I'm one of the owners of, full disclosure, but Next Call Club's SDRs to call on our free leads. And so this is what these numbers look like, okay? So you can see one caller over here, going to call on 3,500 records. Of course, we need to always scrub these things. Next Call Club helps with that, but what the real number is this $25 cost per transfer down here. So the service costs $25 cost per transfer. And what you can see here is that if you get $25 cost per transfer and you're able to close at 17% on the item side, again, I think I'm closer to 20% year to date, and an average premium of $750, mine's closer to $950, you end up with all of this profit over here, ROI. So I will be using this because, again, the ROI is very good. But there are also TCPA changes coming where I'm not sure what the lead volume will look like. I feel like in the medium term and the long term, lead volume will be 100% fine. But from December to January, maybe even to early February, it might be a little touch and go as people start to figuring it out. So I want to have another solution that is not only lower cost than putting a bunch of leads or live transfers, right? We're going to hit all the requotes, the win backs, the X dates, the mono lines, all these things that are already in our database, we are going to attack. The TCPA chains are driving this need. And there's something to remember about this, though. These people are not shopping. So one of the things that's really great about it when they're not shopping is that you don't have a lot of competition. So if you have a salesperson who's not super aggressive, this can be an amazing type of consumer for them. However, because they are not shopping, the sales cycle is a little bit longer. So if somebody's shopping right now and you buy the internet lead or the live transfer or the live call, you might close it on the first call or the next day or that week. If somebody's not shopping, you might be looking at a 2 to 4 week, maybe even 5-week timeline. So keep this in mind. It's something we are going to be indexing on heavily. We've already started it. We're already seeing great success. We're attacking our X dates. We just got the new auto product, so we're going back to the beginning of the year and requoting as much of the things that were in that old auto product as possible. It diversifies our pipelines, and it's going to really help in the long run. So, okay, we're about to bring this thing home here. It's the last thing that we're going to talk about. So we've talked about a number of strategies. We've talked about monolines. We've talked about calling on lists. We've talked about additional coverages. We've talked about flood and umbrella. We've talked about so many referrals, so many things, right? But the last one is just our marketing overhaul. Full disclosure, I will be cutting marketing spend in 2025. I cannot continue to operate at the same marketing spend and make less money and just like nothing's going to change. If I'm able to recoup the amount of money that I've talked about with these strategies, then I can come back up on my marketing spend. But I can't just take a cut and pay marketing. So I have to think about how am I going to overhaul my marketing. And so here's what I'm going to do. I'm going to introduce those other segments. Right? Right now I'm focused on multi-car homeowners. So I'm buying home leads and multi-car homeowners. I will add some single-car homeowner. I will add some multi-car renter into the mix. I do a little bit of those today, but usually it's just kind of by accident. Maybe somebody said they had 2 cars, or they actually have 1, or they said they own their home, but they actually rent. Right? These things happen, but I will actually go out and buy some of these leads. Next, I'm going to put a heavy emphasis on digital and website-based marketing. We've already done this. We're very proud of peachyinsurance.com. We're very proud of the leads that we already generate there, but we're going to continue to build that, right? How can we get people to find Peachy Insurance more often with Google ads, with Facebook ads? When we call people, our caller ID says Peachy Insurance. They Google us. They see that we have 500 plus Google reviews. Our goal is to be at 2,000 next year. How do we make it easy for people to find us and want to call us? We will be using Peachy branding, right, on first-party internet leads. So people shopping, yes, we will use the carrier sometimes, but sometimes we'll use Peachy as well. So they'll actually click Peachy Insurance. We're doing this today. It's going very, very well. We're going to leverage video testimonials. We're going to leverage video in our emails. Of course, doing all these things in a compliant way, but we are going to leverage technology to make these things happen better and faster, okay? And last, we're going to use live inbounds from Next Call Club. So this is not a live transfer. These are consumers who are shopping right now. Maybe they hit a 1-800 number, maybe they hit a Google ad or a Facebook, or they saw a piece of direct mail, right? But if we know that lead volume might be a little bit tumultuous, I still want to get people on the phone. Live inbounds are going to be a great way to do that. So email drip will be really, really important to make sure that we continue to get opt-in. But let's go ahead and wrap this up, all right? I'm going to give you some final tips, and then I'll have you on your way, okay? So final tips. 1, invest in training the team that you already have, okay? Yes, build your team, invest in your team, but train your team, because you already have some amazing people and they already have what it takes to do the things that you need to do, but you need to invest in training them, whether that's you or you're outsourcing it to somebody else, okay? Close rate will be more important than ever. If we expect lead costs to go up because of TCPA changes, we want to make sure that if that person picks up the phone, your team is strong enough and willing to overcome those objections, okay? So if marketing's going to get more expensive, we got to bring close rates up. We got to get close rates up. We can't control the rates. We can't control the competitiveness. We can only control the skill that we have. So invest and train your team. Next, if you're not remote, consider 2025 being the year that you start to work in a remote environment. And if you want to do it right, the reason I would always say that remote can be so amazing is because you can pull wage arbitrage. And what I mean by that is if you live in a place where a really good wage or a starting wage is $20 or $25 an hour and you can't pay that, or it's tough for you to pay that, well, can you hire somebody remotely from a place where $20 an hour is considered amazing? right? I'm in Metro Atlanta. We start people at $45,000 per year. $45,000 per year in Metro Atlanta is not very competitive. But $45,000 per year in, say, Kansas or Mississippi or rural Georgia is very competitive. And so I'm a remote agent for the most part, and that allows us to be very competitive from a wage standpoint. It also helps that we use a PEO. And so I've talked about a PEO being a cheat code before. I've referred people to my PEO. If you want a referral to my PEO, just let me know and I'd be happy to introduce you. But a PEO is amazing because it does all types of stuff for us, right? It's basically our payroll company, but they also have HR consultants. But what we really like having a PEO is for two reasons. One is that it allows us to offer group health insurance for our employees. So whether you're remote or not, if you don't offer group health insurance, but maybe you give them a stipend. I know a lot of agents will give somebody $200 or $250 a month so they can go buy health insurance because running a group just doesn't make sense. Well, if you're part of a PEO, in some cases, you can get amazingly priced insurance. I'll give an example. For us, our cheapest plan is like $60 per month pre-tax. And so we contribute $250 or $275 per month. The employee pays the rest. And so the cheapest plan available for some employees is, $30 a paycheck pre-tax. You have access to much larger groups, much more competitive group pricing. The second thing a PEO is amazing for is if you do go remote in multiple states, keeping up with the state laws can be very, very, very challenging. They do that for you. They keep it easy for you. So if you're remote today or you're looking to go remote, consider a PEO. If you're looking to add group health insurance, which I would highly recommend because more and more people want it, it helps people stick around. It helps people grow. The PEO offers 401k options, etc. There's a lot of benefits. If you'd like an introduction, let me know. I'd be happy to introduce you to our PEO. Final two tips here. You got to focus on efficiency. Everything I've talked about is how do we get more with less? Okay, how do we get more with less? We need more lines per household, lower cost per sale, higher premium offering. So more lines per household means we got to bundle deeper. It's not only about the home and auto, but how do we get the umbrella, the flood, the landlord policy, the boat, the trailer, everything that they have, we want to insure it. How do we get a lower cost per sale? Well, we do that by getting our close ratio up or by getting more efficient on the marketing spend that we have. So that could be calling those free lists. That could be calling your monolines. That could be working your requotes and X dates. And it could be getting your close rate up, doing both of them together. And then third is the higher premium offerings, right? Can you sell higher, better coverage that people will really value? And so the last tip I'll leave you with is it can be really easy to feel overwhelmed when these changes come, but solve the problem piece by piece, brick by brick. It's not going to be built in a day. Again, I talked about it earlier. If I'm losing $28,000 per month, I'm going to find a little bit over here and a little bit over here and a little bit over here and a little bit over here. Okay. So we can do this, right? Changes are scary, but we've got ways to figure them out. I'm here to help. Tons of agents are out there here to help. We have an amazing community on social media for agents. Let's use it, right? Like, let's work together and help each other out. So thank you guys so much for your time and attention if you're still here. If you have any questions, as always, just shoot a reply to this email. I'd love to talk with you. Thank you so much for your time and here if you need me.